Hello, my friends. This is Paul Drockton, and I am the owner of Drockton Boyan CEO. And we're going to talk about how to survive in an inflationary environment, something that most of you have never seen. So, the first question you should ask yourself is, who is Paul Drockton? Who am I to tell you how to navigate these treacherous waters? Well, first of all, my master's degree is in U.S. history and economics. I did my thesis on the Great Depression and analyzed all the economic models around it. And of course, if you understand economic history, it gives you some predictive value. You'll be able to sit down and say, okay, this looks like the same pattern I've seen in the past. Um, I'm a published author. I've written over 2,000 articles, most of them on finance, economics, things along that nature. Accurately predicted the 2001 crash, the 2008 crash, the rise of the euro, the mortgage crisis, current inflation, dollar devaluation, all the things that are going on right now. I predicted it. And of course, I've done all this stuff. So I was a real estate investor, 2007, $30 million portfolio. I built multiple $1 million businesses, and I'm a financial advisor. I have literally counseled thousands of people and helped them to manage their assets. Formerly licensed in securities, I was a trainer. I taught people how to sell mutual funds. Same thing with insurance, and of course, a mortgage broker. So there isn't anything that deals with money that I haven't done. And as you'll see, there isn't anything about money that I don't understand. So let's start off with this graphic right here. As you can see, this is the dollar in 1913. The first dollar that was minted was worth $1, right? Since then, the value of the dollar has continued to deteriorate, right? Today, the dollar is probably worth about a penny because of all the spending and the other things that they've done. So if you're investing in dollars, you're losing money. I want to point that out to you right off. Now, there's a school of economics, right? It's called monetarism. Milton Friedman. He's the one who basically, we'll say he's the one who developed it. And his argument is that the more dollars you have in circulation, the more inflation you're going to have. I agree with them. Now, here's here's the money supply right now. Look at this. Just over the last year, I mean, we're talking about almost a 500% increase in the amount of dollars in circulation. That's inflation. That is inflationary. More dollars competing for the same goods. And of course, the government keeps borrowing more, which is the same as printing more, right? March 2020, we had $2.0 trillion. Through the CARES Act, we had another $2.4 trillion through the COVID economic relief bill in December 2020. We just had the $1.9 trillion American Rescue Plan Act of 2021. We're talking $6.5 trillion in additional spending. That's 1/3 of our gross domestic product. That's 1/3 of everything we produce in this country. Literally the biggest economy on earth. And as you know, this raises our debt ratio, right, to almost 200%. All you have to do is look at the numbers. Now, more dollars in circulation is inflationary. This is the Consumer Price Index. This shows us how much goods and services have gone up in price since a year ago. And as you can see, we're talking about price increases of 4.2% according to the Consumer Price Index. This is in April. This isn't talking about now. This is talking about as of April 2021. Consumer prices were 4.2% higher than they were last year. And if you take a look at the index, right, 42.4% is housing costs. And no one can argue that housing costs have gone up dramatically over the last year. Now, you need to understand that higher interest rates are bad for the stock market. And this chart shows you, right? As interest rates go up, right? Let's just follow the interest rate chart right here. So you can see right here in 1999, rates start going up, right? They were at 4.5%. They go up 2% to 6%. And look at the impact it had on the stock market in 2001. Boom. Matter of fact, the stock market lost almost about 40% of its value. The S&P lost 40% of its value. The S&P 500 represents 75 cents of every dollar in the stock market. Boom, look at that. There's a direct correlation between rising rates, right, and falling stocks. Again, look at 2008. Here's your stock market, right? Here's your S&P 500, almost at 1,600. Drops all the way down to 950. Massive drop. And look at the correlation. Interest rates are low. They start going up, right? This is 2006, 2007. And boom. Right? Here's your collapse. So, long story short, interest rates are one of the biggest predictors of a stock market crash. In addition to that, value is another predictor. So when you're looking at the stock market, you want to look at the PE ratios. And this is the Standard & Poor's 500. This is his S&P 500. Represents 75% of all the money invested in the stock market. So take a look at these PE ratios. Now what this is telling you is how many years it will take for you to get your money back. So if you put money in the stock market right here, it's going to take you about 10 years to get your money back. Now take a look at this. This is right during the collapse of the stock market. PE ratios adjusted, right, all the way down to 5. They correct again all the way down to 5, 6, right? So the stock market, whenever there's a crash, it corrects to value, to what it's really worth. Here's your bubble in 2001, right? PEs are up to 44, right? Interest rates are raised. Stock market crashes and it corrects to a PE of almost 15 or 16. 2008, same thing. PE ratios up to 65, right? Rates go up, boom. Another correction, down to 15. So PE ratios really should be anywhere between 5 and 15. Look where it's at right now. We're talking, what, 44? This is the S&P 500, 44P. This is going to collapse. This is going to crash down to anywhere between 5 and 15. That literally is at least a 66% loss of value right there. So why do you want to stay in a dying investment? It doesn't make sense. So the other thing it's going to do is it's going to impact the bond market. And the bond market bond prices go down as interest rates go up. Remember that. Interest rates go up, the value of existing debt goes down. It's worth less. As a matter of fact, the face value is discounted 1% for every year remaining. So if I have a 30-year bond that I buy, a 30-year bond, right, paying 5%, rates go up to 6%, that means you can go get a new bond for 6%. Why do you want to buy one that's only paying 5%? The only way I'm going to sell it is if I give you back 1% per year off of the face value for every year I have left. So a 30-year bond would lose up to 30% of its value with just a 1% interest rate increase. This is what triggered the mortgage crisis. This is what triggered the bank failures. Is simply because these banks had a ton of debt that was being devalued because of rising interest rates. And the thing you need to understand, this is the global equity market. That's the stock market. This is the global bond market. There's no comparison. Much more money invested in debt than there is in equity. So the three types of bond: treasury bonds issued by the U.S. government and its agencies, municipal bonds issued by cities, states, counties, right? And corporate bonds, which are issued by companies. All of these are interest rate sensitive, which means rates go up, they all lose value. Now, remember, the consumer price index is 4.2% higher than it was a year ago. That means that right now, in order for banks to break even, they have to raise rates 4.2%. It's not a matter of if, it's a matter of when. When are we going to start seeing these rates just going up astronomically? Well, it has to happen, because here's the problem we have. If I buy a U.S. Treasury right now, paying 5% interest, well, over the next year, my real return is only 1.8. I'm sorry, it's actually 0.8% interest. So therefore, I'm losing money. Make sense? Okay, again, looking at the financial crisis, right? This is going to destroy the stock market. Rates go up, the stock market goes down every single time. That's the correlation. And the bond market's going to be devastated, which is going to have a massive impact on what? Real estate. Again, it follows the same pattern, right? Here's your housing bubble. This is pre-2007, right? Now, I sold my house. I bought it in 2001. I bought it for 250 grand. I sold it for 410,000 in 2007 because I knew we were in for a collapse. And as you can see, values went from an average of 190,000 all the way down, right? In some areas, they lost 50%. 50% of their value. Property in Nevada, for example, Las Vegas was 70%. California average was 50%. The point is that when this stuff hits, it hits hard. That's bad. The reason it's bad is because a lot of people are sitting on debt. Their homes end up having more debt than the value. You can't sell it. You can't do anything with it. Foreclosures go through the roof, right? Which continue to pummel values. And we've got other issues going on now that we didn't have in 2007, 2008. One of the issues we have is that we've got a rent moratorium in some states, California being one, right? Landlords can't collect rent. So as a result, they're not making their mortgage payments. They're falling in arrears, which is going to lead to foreclosures. So this is going to be a mess. And trust me when I tell you, if you're going to continue to believe that this wave is going to continue to increase, then you're fooling yourself, period. There's only two asset classes that not only survive but thrive during times of uncertainty and inflation. One is gold and the other is silver. As you can see, right, here's your 2008, right? Here's your 2001. From 2001, you can see values start going up on gold, right? 2008, we have our mortgage collapse, we have our stock market collapse, right? Real estate collapse. Well, gold went from about $690 an ounce all the way up to almost $1,900 an ounce. So it tripled its value, right? And of course, interest rates are lowered, investors move out of gold, move back into real estate, move into the stock market, right? But it still kept its values. And now we're in that cycle again because of uncertainty where gold is continuing to increase. And the same thing's happening with silver. You can follow the same trend, right? 2001 to 2006, right? All the way to 2008, right? Went from 5 to 20. You made 100, you literally made a 300% return on silver. Get a correction, right? Because people don't know what to do with their money. And boom, during the economic collapse, you can see silver went all the way up to $48, right? 48 from 10, that's almost a 500% return. Everybody else is losing money. Rates go down, right? Silver goes down with it. And now we're starting to see silver go up again. So which one's the best investment? Well, first of all, gold increased in value 12% over the last 12 months. So over the last year, gold's gone up 12%. Not bad. Silver, on the other hand, has gone up 80%. So which one's the best investment based on our current environment? Well, there's only one choice. It's silver. You want to get as much as you can. Now, last but not least, I want to give you some strategies here. Let's say you live in a house right now, your primary dwelling, right? If you have enough equity, sell it. Sell your house. Get that equity before you lose it, because you are going to lose it. And then downsize with cash. So let's say that your house is worth $800,000 now, but you only owe $400,000 on it. Sell it. And then buy a $300,000 home or condo, or a $400,000 home or condo. And basically, you've got a mortgage that's paid for. You don't have to worry about losing your home. And if you have whatever you have left over, invest it in precious metals. My friends, these are the keys to prosperity I'm showing you right now. Take advantage of your equity position. Now, for those of you that are real estate investors, right, your investment properties are not going to be worth any more than what they are right now. As a matter of fact, you're going to start seeing values decline as rates go up. Get out right now. Peak market, right? Best time to sell. Sell when it's high, right? Buy when it's low. You know these are going to correct. The values are going to correct, right? Sell them all. Get rid of all your investment property. Pay off your primary mortgage first. Convert the rest to precious metals. And then you can buy back when the real estate market corrects. When it crashes, you can buy back, right? Maybe pennies on the dollar, which is going to allow you to increase your holdings by, who knows, 200%, 300%, who knows? And let's pretend you live in a house and you have some equity, maybe not enough to where you can get another house. Borrow against it, invest in precious metals, and then let your precious metals continue to grow until they get to the point where you can pay off your house. Sell your metals, and you're living in your house without any debt. And by the way, during difficult financial times, any debt is fatal. I don't care what it is. So the strategy should be to get out of debt, right? And to get your assets into investments that are actually going to increase and not go down in value. This is what I do, my friends. As I said, I'm a financial advisor. I guarantee you that I've given you more pure information today than you've heard anywhere else. And there's a reason for that. I'm the only individual in this space that has not only the experience, but also has the knowledge base and the intelligence to put it all together. I'm not bragging, I'm just telling you like it is. So if you want a personal consultation on how to manage your assets, just call or text me, 801-857-5529. And if you're looking to invest in precious metals, do it with me. You're going to get better pricing. If you have metals to sell them to me and get paid more. Long and short of it is we buy and sell gold and silver, bullion. That's all we do. Again, this is Paul Drockton, my friends. God bless and have a great day.